Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are back with our Ask an Advisor series, where we speak to some of Australia's best financial advisors. Today, we're not speaking to an advisor per se, but we're speaking to the Chief Investment Officer of one of Australia's leading advice companies?
Yes, firms, yeah.
Specifically focused on high net wealth individuals.
Yes, we are joined by Daniel Kelly, as Ren said, Chief Investment Officer of Viola Private Wealth. You would have heard of Charlie Viola on the show multiple times over the last number of years. Daniel is the Chief Investment Officer of Charlie's new private wealth firm. And as Ren said, specialise in high net worth clients, and so have their finger on the pulse when it comes to what's going on in markets and how to set up portfolios for a 50-year time horizon.
Now, if there's one thing we've learnt speaking to a number of high-profile advisors over the years here at Equity Mates, it's that they are the belle of the ball.
Yeah.
Every fund manager wants to get in front of them because, you know, some of these big advice firms, you know, if they like you, if they assess you and they think you're worthy of an investment, they can, you know, seriously make funds.
Yeah.
And so it means that Charlie and Daniel have their finger on the pulse on what's happening in the Australian financial landscape. What trends are hot, what sectors are hot, what funds are coming to market, what's perhaps not doing as well. And that's really what we wanted to understand from Daniel, what's happening in markets, but then also take a step back and understand sort of the bedrock rules of portfolio construction and asset allocation that he takes to portfolios for clients at Viola Private Wealth.
Now, just a reminder, as you listen to this and you feel like you would like to speak to Daniel, Charlie, or any of our hand-picked advisors, head to equitymates.com/advice. There's a form there for you to fill in, and we will connect you with the most appropriate advisor for you.
All right, well, with that said, let's get to our conversation with Daniel Kelly, Chief Investment Officer at Viola Private Wealth.
Well, Daniel, welcome to Equity Mates.
Thanks for having me. First time caller, long time listener.
Nice. Well, we want to start broad. You're CIO at Viola Private Wealth. So how are you seeing markets right now?
There's a lot to see, right? And so I've done a few podcasts recently and some kind of, you know, seminars and events like that. Anything we talk about today, it's highly likely that it's going to be dated quite quickly, right?
Yeah.
Because the velocity of information that's coming through and how quickly markets is changing is at an all-time high, I would say. But fundamentally, you know, we've been taking a long look at the US economy and the health of the US economy, because I think that's really what is determining market movements globally. There was a narrative out there that kind of US exceptionalism was kind of over. That rally on the S&P 500 of almost 10% in a single day would argue against that. But fundamentally, there are a couple of, you know, good indicators, like the health of the job market in the US. Inflation is still healthy. But the thing with economic data is it's a lagging indicator, right? So anything that we're seeing now is for Q1, which would have ended March. It doesn't take into account anything that Trump said, you know, in the April 2nd Liberation Day, as he calls it, announcement. So we try and, you know, screen as much of the noise away and focus on the signal, which is typically the hard data. And so at the moment, we can't see anything fundamentally wrong with the US economy, but and that's why, you know, markets have rallied after Trump put that 90-day pause on the tariff implementation. But we're paying a very close attention, you know, to the hard data as it comes through, I think Q2 would be, I guess, more of an indicator of kind of actually what's going on. We had a negative Q1 GDP print, 0.3%. You know, the GDP now is indicating about 1.1% for Q2. GDP is one of the main indicators of equity market, performance. And so, yeah, we're paying close attention to that. And then, obviously positioning client portfolios accordingly.
So you mentioned that a lot of economic data is a lagging indicator. It's backwards looking. It tells us what has already been. What are some of the indicators that you're looking at that give you a sense of where things are going?
Sentiment data is used, like investor sentiment data is used a lot for that. But I take that with a big grain of salt because humans have a big negativity bias with almost everything that they do. And economists, I think, actually do as well, right? So my default positioning is positivity until I see evidence of negativity, right? That's appropriate because markets spend 70% or more of their time going up. So I think that's an appropriate alignment to have. So it's almost innocent until, proven guilty type approach. There are a few forward-looking indicators. The equity market is actually a forward-looking indicator itself because, and I know that people talk about PE ratios a lot. We prefer to look at the forward PE ratio because that takes into account future expected earnings and the growth rate of future expected earnings. And as we all know, you would have covered it, 1,000 times on the podcast, equity markets price in the future, not what has already been. So the PE ratio is a backwards looking indicator. The forward PE is a forward looking indicator. But that's literally the multi-trillion-dollar question, right? Is trying to have a look at where the world's moving forward. It really all comes down to what Trump says and what Trump implements, unfortunately, which is difficult to assess because it can change on a 24-hour news cycle, right? So, and we saw how quickly markets can react when there's a change of policy, literally just by something that he says, like buy now, as an example.
I know.
Which was wild. Did that happen?
Did you buy?
I was. So whenever there's like stress in the markets, we increase the frequency that we're communicating to clients. Because I think the GFC taught a lot of firms that that's exactly when your clients want to hear from you, right? And even if you know everything is okay, we do this as a profession, we do this as a day job. Our clients, are entrusting us with their life savings. So they want to hear from us. They want to hear, where we think markets are moving and how we're assessing kind of, the current environment. So we increased the velocity of how much we're communicating to clients. So I was putting out notes almost every 2 days during that period, just telling clients that, we thought it was sensible to start averaging into the market. And I actually said this to a client in a meeting the other day. If I could take you back to any period in history where the market has dropped 20%, you would probably take the opportunity to add some to your portfolio sensibly, and not an all or nothing decision. It's never that. And whenever we're talking about that, it's not all in or all out, right? We try and steer clients away from that. I don't do that myself because you have to be right twice. You have to be right on your exit, which is hard, and then you have to be right on your re-entry. That rally that was really like a coiled spring shows you how much you can miss if you're out of the market for a single day or a single week when things rally. And I think the velocity of retail money and retail investors and access to the market means there can be huge buying volume that comes in quickly if the narrative changes. April was actually the largest ever inflows into the S&P 500 index, which just shows you that, there is dry powder there ready to go. I think investors have kind of become a little bit habituated to volatility. I hear people all the time, they kind of say like, we think the next couple of years is going to be more volatile. And I'm like, where have you guys been? Like the last 5 years has been incredibly volatile. We had a pandemic, trade war, Liz Truss almost blew up the bond market in the UK. There's been no shortage of black swan events. So we were edging into the market sensibly for clients that had some dry powder. And Charlie and all the guys at our firm kind of, advocate for clients holding a level of cash for opportunities like that, noting that, if they had have persisted, if Trump had persisted, then markets could have dropped another 10, 15, 20%, right? And we were ready for that. It wouldn't have been the first time that we've invested through a period like that. COVID wasn't that long ago and markets almost dropped 50%. So
I guess, can you be more specific? Like, is there an actual framework that you set down and say, if a market drops 20%, this is how we're going to approach it? Or like, what percentage does Charlie and yourself suggest clients have as dry powder, if you can put some specifics?
I think it needs to be a case-by-case basis because there's always something different that's causing a market sell-off. I would say that we would take a good look at the market every 5% and see, and then it's also client by client specific, right? So you can't just apply a blanket rule because some clients may be fully invested, other clients maybe just had a capital event and they're sitting on 80% cash, right? And so we would naturally, take more of an opportunity with a client like that. But we would take a look almost every 5% that the index is dropping. And then if we think that there's, a catalyst that where there's an off ramp within the next, 6 to 12 months, we would consider that as well. If there's something structurally wrong, like the GFC is an example and the Great Depression is an example of actually something really broken in the economy, that there is no kind of V-shaped recovery possible, we would take that into account. But I wish that there was just some blanket rule we could apply. It would probably be somewhat inappropriate to just apply a blanket rule based on, because every single market drop has its own nuances and own differences. And so we take that into account and then we do it on a client by client basis.
Yeah, nice.
Bryce always looking for the easy answer.
Yeah, come on. I need more than that.
I would love, I studied like thousands of formulas in the CFA and almost none of them work in the real world. And it's kind of annoying because like when you're memorizing all these formulas and you're studying them, you think it's like, oh my God, I've found the thing that I can just apply this. And then
the markets, yeah.
And then I think people look for those solutions because it's easy, but the world's a complicated place.
I guess to build on that though, like what would you be deploying into? Because to your point, COVID happened so fast. This happened over like 3 days drawdown or 2 day drawdown and then bang, 10% up.
Yeah.
If you're dusting off the watch list and trying to fiddle around and figure out what to do,
100%.
You've missed it. So how do you advise clients from that perspective, like what to actually buy?
Yeah, we've got no problems using passive index funds at periods like this. And it's for exactly the same reason that I said before. So when things are changing literally on a 24-hour news cycle, you don't have a week and a half or 2 weeks to sit down and decide whether you're buying Tesla or BYD, right? Because to actually do your research, that takes a long time. Even just to read an analyst report, like a full analyst report can be 25 to 30 pages. For you to go through and read that for 10 or 15 different stocks you're considering, you might miss the opportunity to deploy capital. And it's important to point out, we're not a trading firm. Set everything that I'm saying in the context that we're more looking at opportunistically deploying capital into periods of weakness where we think there's an opportunity to create value for our clients, but we're not looking at buying, selling on a short-term basis, right? But to get money into the market quickly and efficiently in a risk-considered, highly diversified approach, we're happy to use passive ETFs like the S&P 500, the NASDAQ, things like that. I was doing that with my own personal money, so NDQ was what I was averaging into on the way down. I also think that for a lot of clients that maybe don't have access to a wealth management firm like us, where it's our day job and our area of expertise, the simple and easy thing is often the best thing to do because it reduces the friction of actually deciding to make that choice to invest. I've had plenty of friends and plenty of colleagues over the years that would have loved to have bought a lot of the dips that we've been blessed with over the last 5 years, and they did it because they couldn't decide what to do quick enough, right? And then, like we said, I think market rallies are faster than what they've been historically because the composition of the market base is very different than it was in the 1980s. It was just institutional investors, right? And we saw a lot of instos miss buying the dip during COVID. It was the retail money that was actually coming in and kind of taking advantage of that opportunity. So we're happy to use those instruments or actively managed funds, right? So we're kind of blessed that we get access and we do a lot of work to separate out some great managers from some poor managers. And so deploying money into those instruments where you've got a team of highly educated, experienced professionals managing that pool of capital, we're happy to use that approach as well.
Good to hear.
Yeah.
We're recording this early May. We're a bit more than a month out from Liberation Day. We've had the market crash. In Australia, we're actually up from Liberation Day.
Yeah.
In the US, it ticked up, but then it dropped back down. The S&P 500 had 9 straight up days, best run since 2004.
2004,
But at the same time, what you were saying earlier, Trump could say something at any point and things could go wrong.
Yep.
So how are you thinking about this moment now, 1 month out, where markets they have recovered by the numbers, but like uncertainty's probably never been higher about where things go from here?
Yeah, policy uncertainty is particularly difficult to work out, right? I'd like there to be a lot more positive news headlines about the recovery. I don't know about you guys, but I've seen almost nothing. Or if it is, it's like at the back of the paper.
This is our thing. Crashes are front page news. Recoveries are just in the business section.
I literally sent out a client note last night to the firm saying, where are all the recovery headlines? And it was, and actually, I want to lead by example with this, that I don't want to just be talking to our client base when things are going poorly. Number one, because I'll inadvertently classically condition them that if they see
become the negative guy.
Is everything okay, right? Yeah. So I want to be talking to them also when things are okay and when things are going well. But I just painted a quick overview of the crash. That was a historically sharp drop. It wasn't a historically deep drop. So, we got down to about negative 20%, right? We were kind of teetering on a bear market there for most markets. Australia was a little bit better off just because we don't have as much tariff exposure as the rest of the world. We run a pretty decent trade deficit with the US, so we're not as impacted. Yeah, touch negative 20, incredibly sharp rally. That 9.5% rally was the 8th largest rally ever for the index, the largest since World War II. So 9.5% in a single day for the index is like Titanic, like if you set that against the average 50-year return on the S&P 500 of the same amount, 9.5%, it did its average annual return in a single day.
Yeah,
right. That's big. Yeah, that's big. And it all came off the back of Trump, delaying the implementation of those reciprocal tariffs for 90 days. And the reason why he did that is, I think it's fair to say that, the Trump 2.0 administration is happy to endure some equity market pain. But when that starts to spread to the bond market, that's when they really start to get worried, because the US relies heavily on foreign investors buying their debt. And so the equity market started to sell off. But what actually happened is treasuries, the 10 and 30-year treasury yields spiked by almost 50 basis points. So there was some really heavy selling in the treasury market. If you start to undermine treasuries, which is globally the risk-free rate. So every other investment instrument has its very first, if you think about it like building blocks like Lego, right? So the treasury risk-free rate is the very first building block, and then you have risk premiums above that. So if you've got, for instance, investment or high yield debt, you've got a credit spread above that, but it's a credit spread above typically what treasuries are yielding, right? If you undermine the sovereign and risk-free nature of that market, you've got major problems. We saw that in the UK with Liz Truss, right? So there was a major blow up in the bond market. I think Besant, pulled Trump aside and said, okay, enough's enough. Like we actually have to reverse course here, or we're going to genuinely do some damage. This isn't just equity market pain that will recover. So they put that 90-day implementation in, and then we saw, some very aggressive rallying after that. Before that point, it didn't look like we had an off-ramp, because, to be honest with you, it was quite unexpected for Trump to kind of reverse course. So that's put us where we are now. The health of the US economy is still relatively strong. We're watching that closely. And then really all eyes on what the resolution to some of these trade deals, primarily China, is about. And if there's we have put ourselves in a position now where it could be a 0 for 0 type outcome. So if other countries are able to drop their tariffs to 0, the US may potentially go to 0 with them. I think they've snuck through the 10% base level.
Yeah.
And it's classic art of the deal from Trump. He threw out an initial volley that was so kind of over-exaggerated, that got all the headlines. And I think they're going to be able to actually sneak through a 10% global tariff, which is probably maybe where they ended up wanting to be. But moving forward, it's just all about GDP. So GDP growth.
All eyes on July 8, I think it is.
Yeah, exactly.
Well, we want to zoom out a bit and have a discussion around portfolio construction, because that's what you guys are experts in when it comes to.
What mostly matters,
Yeah. So if that's what mostly matters, how do you think about it holistically? And then, I guess in your role, you're thinking about it from a client perspective. What trends are you seeing emerging at the moment?
Yeah, so portfolio construction really started with the 60-40 portfolio, right? 60% equities, 40% bonds. And the thesis behind this was this gives you a better risk-adjusted return than just going into any one particular asset class. So if you had 100% equities, that's portfolio A. You had 100% bonds, that's portfolio B. By combining the two asset classes together, because there are differing risk factors that affect each of those components. I mean, we've only come up with two ways to fund a company. It's equity or debt, right? So if you combine both of those, you're getting the income from the bonds and the defensiveness of the bonds, which typically bonds rally during periods of market stress, which means that there might be something that's causing equities to kind of lag, and then vice versa, right? So if we're kind of in a high growth environment, low inflationary environment, equities rally, bonds don't do as well. I've been doing a lot of research of late to really make sure that, Viola Private Wealth is at the forefront of asset allocation research and really innovating in this space. And so if Harry Markowitz, who came up with the 60-40 portfolio, had access to the tools and the markets and the instruments that we do now, I don't think that he would come up with a 60-40 anymore. It'd probably be more something like a 40-30-30 portfolio. So KKR put some research out about this, where it's 40% equities, 30% bonds, and then 30% alternative investments or private markets.
Okay.
And then that 30% is where you've got your private credit, your private equity, your venture capital, your hedge funds, your real estate, your infrastructure, right? And the reason for this is we just spent last, 30 minutes talking about volatility, right? So whenever you're looking at a risk-adjusted return for a portfolio, it's an equation, right? So in the numerator, you've got your return, and then the denominator, you've got your volatility. The higher the volatility, the lower the Sharpe ratio, right? So what you're trying to do is reduce volatility and increase return. And you want a return to increase at a faster pace than you're increasing the volatility of the portfolio. So by adding alts into this, alts aren't marked to market like publicly listed equities are, meaning that there's not as much sentiment-driven buying and selling. And so although there's arguments that the actual underlying financial volatility of the alts is higher, like for example, venture capital is like micro cap investing, right? So these are businesses that might be 1/100th the size of a micro cap listed equities. You can unsmooth the volatility of, say, VC, and it ends up at about maybe 30 to 40% annualized vol compared to about 15% for equities. Although that's the case, there is huge utility in the emotional dampening effect of including alts in a portfolio. So an analogy that I explain to clients and anybody to understand this is your family home is an alternative investment. That's private property that you own, right? It's not publicly listed. No one can come and buy and sell it. And people hold that asset for multi-decade year periods because they don't see the price bouncing around. Theoretically, with everything that was happening with Trump, someone's property may have potentially dropped by 10% if you are able to price it. But because you don't see that, and you also don't have the ability to transact, you're not tempted to go and say, oh my God, we just bought this for $1 million. It's now worth 940. Let's sell it, right? So people hold these assets for a very long period of time. And so alternatives have a similar emotional effect in a client's portfolio. And so not only that, they just enhance the risk-adjusted return of the whole portfolio. So we're going to be rolling out some new model asset allocations soon that take into account all of the latest research. I had a call with Blackstone last Friday. They've got some unreleased research that they shared with me. We're looking at Ares, Hamilton Lane, KKR, Apollo, all of the kind of, huge global asset management firms. And in general, there's kind of advocacy for between 30 to 50% allocation to alts.
Yeah, right.
And that may seem high to a lot of
I'm sure they're advocating for it.
I actually said that. I actually said that to Blackstone. I was like, by the way, I know that you've got a bias here. You've got a bias here to try and ratchet this up as much as possible. There's a lot of independent research. I actually wrote a paper on this that I might share with you guys after this that was published recently on this.
Yeah, great.
So alternatives and its role in modern portfolio management.
We can include a link to that in the show notes if it's publicly available.
Yeah, it is publicly available.
Yeah, great.
Yeah, so it got published a few weeks ago and just explains the history of alts, how we use them in portfolio construction. So I will write a paper on all of my findings with this asset allocation research because I think asset allocation determines 90% or more of a client's portfolio return. And so you need to spend a lot of time thinking about it.
Yeah. So let's dig into that. So 30% in alts, but then you listed a number of different alternative investment options. Subcategories: private credit, private equity, venture capital, residential property, everything else. But the good news is that it's not just people who are clients of Viola Private Wealth who can 100%. Invest in these asset classes. Like, more and more, the minimums are coming down. A number of these asset classes now are listed in ETF wrappers.
Yeah.
And so, people like Bryce and I can access more and more of alts as well.
Yeah.
So how should we think about constructing that 30% sleeve?
It totally depends on what you're trying to do, right? So
maximize return, minimize volatility.
Go to the moon.
More return, no additional risk. I've had in my career clients ask for that, and I'm like, I'm looking for that magical instrument as well. It depends on whether you're looking for income or whether you're looking for growth, right?
Let's say
go
growth.
Let's
Bryce and I
okay.
think we're young still.
Yeah.
Okay, so there's a
we are.
You guys are. But even if you're not actually, so we say at Viola that everybody has a 50-year investing horizon, regardless of your age. Because if you're 80, you're investing for the next generation, and you still need to think in a 50-year horizon.
Yeah.
If you're 30, then of course you've got a lot of your life, before you. So regardless, you should probably take a long-term view, regardless of whether you have 10 or 15 years left in your life or whether you have 100 years left in your life. So there are a few sub-asset classes, like we were talking before about, publicly listed equities and bonds. Just to clarify, traditional asset classes are stocks, bonds, and cash. Long only stocks, bonds, and cash. And alternative investments are all the other categories that I kind of rattled off before. But certain subcategories of alts will lend themselves to an income or a growth objective, right? So private equity, for example, don't expect any income from that. You can expect a lot of growth from that. It's the highest returning asset class of them all. Typically, you're expecting 20% plus IRRs from that. So $1 in, you're maybe putting $3 or $4 out in 10 years' time. But you need to have a very long time horizon for that, because businesses take a while to grow, right? You guys would have seen this with your own podcast. This is a private equity investment. It doesn't just, build itself in 12 months. It takes 5 or 10 years to build a good company. So private equity is a growth type investment. Infrastructure kind of saddles both of it. You're typically expecting probably between 10 to 14% total return for infrastructure, and then maybe half of that as yield along the way, just because infrastructure is, contractual based cash flows that are ratcheted to inflation. So we really like that at the moment as far as, an asset class for clients to consider, because it is a really good inflation hedge, right? So it's kind of playing a similar role as gold would play in your portfolio, which is typically how people would hedge inflation, but you're getting paid a really good yield along the way. And then it's literally the cash flows of the, the port or the airport or whatever, that the fund is investing in is pegged to inflation. You can then look at venture capital. You got to be careful with venture capital, just because you're really backing the jockey. Because it depends on what stage you're investing in. If you're investing in pre-seed or seed, that's really early. And so you literally might be investing in a company with a pitch deck and an idea, right? There's not a lot of financial modeling that you can do when it's literally just a founder that maybe is a very credible person, but there's not much, forecasting of revenue that you can do. And then you've got later stage PE where you're investing in established large businesses. There's a lot of take privates that are happening now, so leverage buyouts. And there's a trend of public markets of businesses to choose not to go public. So SpaceX is a good example of this. 20 years ago, that company could have gone public 10 years ago, easily. It's a huge business, but they are choosing deliberately, probably because Elon saw some of the backlash that you get with Tesla. And a lot of businesses are just saying, we don't need the stress of reporting to the street.
Yeah. Well, normally you had to do it because you needed the financial weight of the public markets to keep raising money. And now there's such deep-pocketed private markets. Yeah.
That ties perfectly into our discussion of alts. To access the opportunity set of amazing businesses, it is no longer just the public markets that you can do that in. It's now private markets. And a lot of the companies that you would have loved to invest in publicly 10, 15, 20 years ago, or even the size of the businesses, some of these private companies are massive businesses now. And so I think people kind of need to reorient their thinking about what private equity is. But, for a balanced portfolio, you may be choosing, you're choosing infrastructure, you're choosing PE, you're having some sensible allocation to venture capital and property on the growth side of things, and then using private credit, private debt, asset-backed lending on the defensive, more income-focused alternative side. And I'd say that's even a 50-50 split for that if someone doesn't want to go down to the granularity of like 20% here, 18% here, a 50-50 split would do well.
So that's the theory behind it. Getting access to these asset classes for retail investors, probably the easiest way is through managers.
Yeah.
And I imagine that's what a large part of your role is actually assessing managers in all of these different areas. So what do you look for in a good manager? What's your process to assess them?
Yeah, my inbox is like flooded with managers. So in the last probably 2.5 months, not joking, I've probably got 160 pitch decks sent to me by managers because they know we're advocates of private markets, and they know Charlie has been kind of at the forefront of allocating to this. So deal flow is not a problem, I'll say that. Assessing a good manager from a bad manager is hard. And what I kind of tell a lot of clients is, or a lot of other groups, is if you're spending less time on doing due diligence on a manager than you would a high school assignment, then you're probably not looking deep enough. So how long would it take you to write high school assignment? Maybe 20 or 30 hours, right? For a decent sized assignment.
That seems like...
I reckon Daniel probably did better in high school than we did.
Yeah, look what you're doing.
Subject, right? Okay, let's say a hard subject. You're spending 20 or 30 hours and you're not rushing it at the end. To understand a fund at its core and to uncover the red flags, because they're not obvious. And so a pitch deck that a manager sends you is marketing material. Right? It's marketing material. So it is always going to tell a positive narrative, and every manager is going to look good when you flick through the pitch deck. You've got to go down into the weeds to actually find out what's going on. And I find typically that takes me between 40 to 60 hours. And there's normally a back and forth that we go through with a manager where maybe there's 40 or 50 individual questions that's asked. And I'm understanding things like the profitability of the actual fund itself. So split the investment strategy out. Are you guys actually making money to pay your portfolio managers to attract talent? Is a huge thing. If you're running a negative cash flow burn, we're not only taking risk on the actual strategy, we're taking risk on you as a business as well, right? And so that's something that we want to exclude. But we have a deep DD process. We've got 10 individual items that we go through. I write typically between a 15 to 20 page report on the fund and present it to our investment committee. And then we need a unanimous vote of yes from all our investment committee members for it to go through. That's hard for any individual investor to do that hasn't, spent most of their life working in markets like we have. I would say for the average investor that's looking at getting into, alts or a category like that, probably stick to your big household names that have a really great reputation if you don't have the ability to do it yourself. But this is where advice really comes into play, right? Because we are experts in navigating these markets, and there's great alpha to be made in private markets. But if you're going into a fund, and investors can get into funds with long lockup periods now with 50K minimums, 100K minimums. Yeah. It's not 5 million like it used to be 20 years ago. If you're locking money up for 15 years in a private equity fund and that underperforms, and that does, annualized return of even 3 or 4%, let's say you don't lose money, but it's just underperforming, that is a drag for, a decade and a half, right? Where it could be earning money in simply just the S&P 500 or something like that, right? So the opportunity cost of getting something wrong is heavy with private markets, which is why you really need to understand what you're doing. But there are semi-liquid vehicles now, you kind of mentioned. So there's kind of 3 stratas the way that I look at it. So there's your true private vehicles, right, which is typically wholesale only, high minimums, high level of kind of expertise to have a look at it. There's the second level, which is like semi-liquid vehicles now. And there's a lot of innovative structures being created where they're taking what was traditionally illiquid markets and creating liquidity. And there's a few ways that you can do that depending on the asset class, typically quarterly or 6 monthly liquidity in those vehicles. And then you've got the publicly listed, obviously, vehicles where you can get T+2 days liquidity. What I would say to people is look at liquidity with a grain of salt with alts, because it's illiquid so long as the fund can provide that liquidity. It's not the same as public markets, right? So you'll never have to worry about, well, I shouldn't say never, there's always some moment, but very, very unlikely you need to worry about liquidity with deeply traded stocks on public markets. You can hit what's called a NAV gate in private markets. And so they do this to protect investors from a fire sale type event. If there's a fund that offers quarterly liquidity and 60% of the investors want to redeem, let's say there's nothing wrong with the fund. Right? There's nothing fundamentally wrong with the portfolio, but 60% of investors want to get out and want to hit the door, then the fund would have to sell a large majority of its assets. And to do that, the market would know that it's selling at a discount, and they would need to sell it below what the assets are actually worth. So they put in what's called a NAV gate, which is typically 5% of the fund's net asset value, typically a quarterly or 6 monthly basis. And they limit restrictions to 5% of the value of the fund every quarter. And they do that to protect investors, actually, so that you don't have a NAV that drops from $1 down to 74 cents and there's nothing wrong. It's just that they need to give the money back to the investors, right? So you need to have a look at some of those things, and also just understand that if you're investing in a semi-liquid vehicle, take that liquidity that's printed on the tin with a grain of salt and build that into your portfolio construction, because the time that you need your money back, you may not be able to get it as quickly as you would like. Because typically when investors are rushing to get their money back, things are going wrong in markets. And that's exactly when liquidity evaporates quickly, right? So liquidity is kind of this oxymoron or this catch-22 where it's always there when you don't want it, and then when you want it, it kind of dries up pretty quickly, right? And so that's why, a proper asset allocation strategy and a portfolio construction approach. So you're going to the other segments of the market to get your liquidity, like your public stocks, public bonds, or your cash holding.
Nice.
So you mentioned your inbox is filled with fund managers pitching their wares. What are the trends that you're seeing? Like, what should we be aware of? Like, it feels like private credit was the hot story for the last 3 to 5 years. Is there something else that's coming through? Is it still all private credit? What are you seeing in that inbox?
So it's kind of interesting with private credit, because for a lot of us that have worked in the space that we work in, private credit's like not new at all. Like, this has been around for a long time.
It's just a lot bigger.
It's a lot bigger, and I think the inflows into private credit came off the back of base rates being increased, so central bank rates getting ratcheted up. And so what I was saying before about that risk-free rate and then there being a premium above that, so private credit is constructed exactly this way. So if you've got, the 10-year US Treasury at 4.5%, right, you'd expect a premium for private credit typically 400 or 500 basis points above that. That's why private credit's pumping out 10 to 12% at the moment, right? For a senior-only kind of fund, if you go further down in the capital stack, you can kind of increase that return. We're not advocates for that. We like the senior tranche because we want it to be defensive. So there's been a lot of inflows into private credit, where we're actually going to be running a session for clients soon where we talk about private credit and just get rid of some of the misnomers and, some of the false rumors out there about it. Like any other asset class, you have to do your research, like I was saying before, and there are managers that do the wrong thing and there are managers that are amazing at what they do. So manager selection, whether it's private credit or any of the other subcategories of alts, is always, first and foremost. Private credit is still kind of what you'd call the hot trade because, the returns are really good, the volatility is low, and people like cash flow. Right, which is why people, typically the first port of call, and I hear this talked about a lot on your podcast, is like dividends, right? Like everyone's kind of investing in equities for dividends. Kind of a little bit counterintuitive because equities is absolutely a growth asset class. And so if you're going into a growth asset class just to generate income, it's kind of at odds with the inherent structure of what that market is. Whereas private credit is income, right? So if you're generating a 10 to 12% return, everything of that is cash flow back to you. And so that's really attractive, right? Because you're kind of being rewarded with positive cash flow on a monthly or quarterly basis. I think infrastructure, I mentioned before, I think infrastructure is the new private credit.
Okay.
And I think the reason for this is inflation is no longer just something that people understand from, studying economics at uni or reading a textbook, and it's like this theoretical concept. Like we've gone through a period of lived inflation. So the average investor now understands how much that hurts because they see the prices going up at the supermarket. I also think that CPI as a measure of the actual tangible inflation that you experience as a participant in the economy doesn't work that well. And what I mean by that is, the price of your barbecue chicken hasn't gone from $10 to $10.50. It's gone from $10 to $15, right? So it feels like inflation for what I'm actually paying, I don't know about you guys, is running higher than what the inflation rate is telling us. So what this means is clients are now looking and saying, okay, how are we building some inflation hedging into our portfolio? Like how can we do this, right? Because inflation is, a stagflationary environment is the worst possible state for an economy to be in, where you've got low GDP growth and you've got high inflation. That kills almost every asset class, except those that are inflation hedged. So gold was traditionally used for this purpose. Bitcoin was purported to be used for this. Doesn't seem like it does, right? Because it seems like it's still very correlated with the NASDAQ, which is negatively correlated with inflation. So building inflation hedging into a portfolio without compromising your return, I think infrastructure does that really well because you can get equity-like returns. You can get positive, good carry along the way, 5 or 6% income paid quarterly. It ticks a lot of boxes in a client's portfolio. So I think and I'm actually seeing that being talked about more and more, and I'm seeing funds launching infrastructure funds more and more. So I think we'll be hearing a lot more about that in the next couple of years.
Infrastructure is the new private credit.
Jeez, not quite as sexy, is it?
It can be.
It can be. Are there any long-term trends that you're also positioning clients for, like in terms of equities or what you're seeing private credit investing in? Are there anything that you're really sort of saying, we believe the next 10 years, this is where you need to be?
Trends now are a little bit more difficult to predict, I think, than what they were before. The AI trend is obviously, and so actually the AI and data storage trend is an infrastructure play. So data centers is an infrastructure type asset. And so when I say infrastructure, people probably think ports and airports and kind of like what traditionally would be like large infrastructure type and toll roads and things like that. The increased propensity to need to store data flows through to almost everything. And then the efficiencies that AI is bringing into every single business. I said this to a client the other day, like to invest in AI now, you don't just have to invest in an AI company like NVIDIA.
Yeah.
AI is being permeated into every single business. And it is creating efficiencies. It's increasing profit margins. It's meaning that businesses can do at a smaller scale what was only done by 50 or 100 people. You can do it with 10 or 15 people now. So I think having a look at that, there's hypothetically an argument that the market deserves a higher PE ratio because of this, actually, because in the same way that the internet, investing in the internet, I know that the dot-com boom and bust, it was difficult to pick who are going to be the winners and losers of a trend like that. I think there's a lot of similarities with AI that there is with the internet. It's undoubtedly going to be a wave that's not going back, and it's going to permeate the world. And almost every business is going to be a recipient of it. We use it effectively. I'm sure that you guys use it, with your work as well. And so every single business model can be enhanced by this. I think those that are a little bit more courageous with implementing it into their day-to-day and not being afraid of it are going to be the winners. But we're still at the stage where you need to have a human in the loop, right? So you can't purely just trust the output of a model, and it would be inappropriate to do that. You need to have, human intervention within that. But we're asking a lot of managers about how they're investing in that and then how they're looking at that with their security selection as well.
Yeah, nice.
So, Daniel, I feel like we could keep talking for a while, but we'll have to get you back on when you've written that paper and we can unpack alts some more. But we wanted to wrap with this question. You speak to a lot of managers, you hear a lot of views on markets and how people should invest.
Yeah.
So what's one commonly held belief or a belief that you hear a lot that you think is perhaps wrong or just outdated?
Okay, you guys know the saying cash is king?
Mm-hmm.
Yes.
I think what it was meant to be is cash flow is king.
Yeah, okay.
And it got kind of simplified to cash is king. Holding too much cash is just a corrosive force on your portfolio over time. There's an opportunity cost to holding cash because you're not taking risk with that money, as in you're not allocating risk. It means your purchasing power is going to be eroded by inflation over time, very consistently, very predictably. So anybody that's holding 40, 50, 60% of their net worth in cash would probably be asking, like, do you actually need that much liquidity?
Who's holding that much in cash?
I think you'd be surprised.
Okay.
I think you would, if you looked at the average balance sheet of the average investor, I think their cash holding would be that high.
Yeah, right.
If we dissected, an average investor's balance sheet, and if we went to a client and said, hey, we're advocating for a 60% cash holding over the next 10 years, they'd be like, I'm not paying you a fee to hold 60% of my money in cash. It needs to be invested in a risk-considered way. So there's an opportunity premium to cash. There's a joke where it's like, if you're fully invested, then, when markets drop and it's like, what are you going to use? What dry powder to use to actually invest? Like, you're fully invested. Like, what do I actually have to buy here? So having a sensible cash holding where it balances, I guess, the trade-off between, the inflation eroding power over time, and then also having the ability to deploy capital opportunistically. But I'd say just have a look at your cash holding is probably the misnomer that I'd say. And yeah, the cash flow is king thing is businesses that produce a lot of cash flow are king.
So, I mean, the obvious follow-up is your cash weighting is obviously personal. It's based on your financial
100%.
Circumstances and the goals that you're trying to achieve and when you're trying to achieve them.
Yep.
But in a general sense, for the blended average person, what's like the right cash buffer range?
Our asset allocation models would typically hold about 5% cash.
5%.
Right.
Yeah, okay.
Yeah. But
nice.
to your point, it's absolutely dependent on what is happening in that person's life. If someone's got a near-term or medium-term expense, like a property settlement or something like that, we're not investing that money, right? We're not taking risk on that. We don't want to risk the volatility. We'd hold that in cash. But if you have no material expenses coming up, then I'd just weight your cash allocation according to what you actually need it for over the next 2, 3, 4 years. And then obviously keep enough in the bank that, you can meet any near-term expenses, but it's a personal thing. But I think people probably need to have a look at that because not having that money invested and deployed in markets, you can't calculate what it's costing you, but it's empirically costing you something.
Well, Daniel, as Ren said, I think we could keep talking for hours. It's been incredibly interesting, but thank you so much for coming in today. We really do appreciate it. If you're sitting there listening and you would like to chat to Charlie, Daniel, or the team, a reminder, you can head to equitymates.com/advice, fill out the form, and we'll put you in touch if they are the right advisor for you based on the information you put in. But Daniel, thank you so much. That was really good.
Thanks, guys. Appreciate it.
Thanks, Daniel.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.